I made a previous video to show how to use DealCheck to evaluate flip projects. So go ahead and see that first DealCheck video for more details on using the software and setting everything up correctly. I'm going to move forward on this video to use DealCheck to evaluate BRRRR projects, meaning the stage 2 refinance added on top. So DealCheck is going to allow for BRRRR project evaluation, everything in the stage 1 calculation that we did in the other video for the purchase and rehab phase. Here we can also now add in the long-term refinance details. We can add in the long-term property expenses to hold the property. And we can also add in percentage growth projections for things like property value, rent, and expenses as they grow over time. And this will be done for running all the calculations eventually to show profitability and return metrics for a long-term rental holding with milestones every year along the way. So let's go ahead and just summarize the short-term purchase and rehab loan that we set up in the other video. We're going to obviously build on that for the refinance. We had the purchase price of $150, the rehab of $50, and an ARV of $280. We considered that a good project. And we did check the comps on the ARV, and we settled on that amount in the end. We did have, of course, no rent at that stage. It's a vacant property undergoing rehab, but of course we do have holding costs, which are taxes, insurance, and utilities to keep the property functioning properly during the rehab phase, and that was $417 a month. So we added a short-term purchase and rehab loan on top. That was 80% financing on the purchase with 100% of rehab funded. That equaled a $170,000 loan amount, 12% interest, terms 12 months. We only had a 4-month holding period, though, with a 3-month rehab project and 1 month to sell the property. We had a total invested cash with this financing scenario of about $46,000. That includes the $30,000 down payment, plus those holding costs, including the loan payment, over the 4-month hold. So the pre-tax profit on the 4-month hold was about $47,000, and the after-tax ROI was 308%. When you annualize a 4-month hold, it's going to be approximately 3 times the simple return on investment. So now we want to set up the long-term refinance with these values. The ARV is indeed going to be kept stable at $280. We are going to use $1,900 in rent. We are going to check the rental comps in DealCheck to make sure that's an accurate number. We are going to have holding costs of taxes and insurance. Now, utilities will be passed on to the tenant to pay every month, so the holding costs will drop down to $267 per month. We're going to put in a 75% loan size here. That's a $210,000 loan size. With the $170,000 payoff of this first loan, we are in a cash out refinance situation. We are going to use an estimated interest rate here of 6.5%. By the time you're watching this video, it could be higher or lower, but these days 6.5% is somewhat reasonable. And in the typical DSCR term will be the full 30-year amortization. So let's jump into DealCheck and see how we set this up and get our profitability metrics and evaluation within the software. Now we are in the DealCheck software. We are in the BRRRR tab here. The first thing you would do would normally be to add the property. I've already added this in here to save a little time on the video for the data inputs. I'll come back here in a second. But when you first come in the BRRRR area, you'd want to set up your purchase criteria. Similar to the flip criteria we did in the previous video, you're going to set up one or more metrics here to make sure these are rules that meet your minimum investment standards. So we'll set up a few of these. Let's take these one at a time. We'll take a purchase metric, meaning total cash invested is no more than $50,000 out of pocket. 70% rule, we want to keep our cost no more than 70% of the ARV. So that's a pretty standard rule in the real estate investing business. For the cash flow on the eventual rental property, we could do something like 1% rule, but let's take a cash flow rule, saying we want at least $250 in cash flow per month after expenses and the loan payment. The investment returns, we are looking here, in this case, we'll set up cash on cash return of 12%. So these are the 4 scenarios, in this case, the 4 rules that we want to make sure our projections meet. Now, we could modify these, we could delete these, we could adjust these, but this is the setup for starters. So now when you come back to the main BRRRR tab, you're going to, at that point, add the property. So as mentioned, I've already set this up, so let's go ahead and go inside it. We are taken to the property analysis tab, but I want to start up over here in the property description. This again is pulled in on the address match. You should not have anything you need to change here. Of course, you could add descriptions and notes, things that will help you with evaluating the property. Let's go into the purchase worksheet because that was the key area that I did for the setup of all the information matching. Let's just review everything. Remember, we're setting up the entire project here. We're setting up the first phase purchase and rehab, and then we're setting up the second phase refinance, all in the same tab here. So initial purchase 150, ARV 280. When we did that, we looked at the recent sales comps to be comfortable with the 280. We do want to set up initial financing. So this was the purchase and rehab loan number one, financing of purchase and rehab cost. The down payment was 20%. The refinancing was done at 100% available in draws as work is completed. It's an interest-only loan at 12% for the 20% down payment, which is typical out there. And we're leaving the loan term blank because the instructions are to leave this blank when you refinance the property. What we are planning to do here, this part would be for second position gap funding on the initial purchase. That's not going to be really permitted in the hard money lending world. Let's skip that. Our initial purchase cost we set to 5%. We could have itemized it. Let's keep it simple for now. Our rehab costs were 50. No need to itemize that here. We'll just do the lump sum. No cost overrun here because we have a contingency within the 50 to work with. And again, a 4-month holding period, which means a 3-month rehab period and a 1-month period to refinance the property. So now we are setting up the second stage refinancing on the same tab. This is refinance number 2. We're going to finance the ARV. We want 75% of it. This is going to be an amortizing loan at the 6.5% over 30 years, everything matching what I just described. We are going to put in a lump sum estimate for the refinancing cost at 3% of the ARV. Size. The rental income is going to be $1,900. Now, I'll come back to that in a second to judge the comps. Let's put in a 0 vacancy rate. On single family properties, it's pretty easy to keep those rented for the most part. Vacancies are really going to come when you have multiple units that are hard to keep fully occupied at all times. Let's keep that 0 on a single family. Other income would be things like laundry, parking, and storage if you want to add that in there. That's not going to be done here. Our operating expenses, again, as described, $417 during the rehab because we pay for the utilities and then we transfer the utility costs to the tenant. During the rental phase, we maintain taxes and insurance. And our long-term projections here are pretty conservative, 3% for property value appreciation, income, meaning the rent, 3%, and the expenses, 3%. Selling costs, if we do want to sell the property at some point in time, we put that at 6%. And one of the biggest parts of owning real estate is the depreciation tax benefit. So we'll just keep that at the 27.5-year depreciation period, and we'll put the land value as such. Refinance in the future, we're going to not complicate this scenario. That's something you could add on top. But right now, we're just planning to buy and hold for an indefinite period of time. So going back up to the rental comps, we want to make sure that this number has some validity. So DealCheck is going to allow at the higher levels of this service a rental comp comparison. So it's calculating out 2290 for us. When we go down there to see which rental comps it's using a bunch of these because I have the highest level of software and you could have unlimited comps. But you can see these are ranked by similarity score, so descending here. So these should be the best ones. I'm not sure why it's calculating 2290 based maybe on a square footage raw calculation, but the actual market is not bearing that out. I don't see anything even close to 2200. I do see some at 1900 plus, 1995. So we are going to pull this back quite a bit. Let's keep it down to 1900. That should be pretty feasible with this newly renovated property. We don't know how recently renovated some of these are, so we hope that the proper rent is going to be obtained for a nicely renovated property. So when we go back to the purchase worksheet, all of our information is set, including the rental comps. So now we want to take a look at the property analysis tab. Here in the property analysis tab, we have the main numbers summarized here. We have the cash needed, down payment plus closing cost, the ultimate cash flow coming out of the rental property that you'll see in a moment, and some percent return metrics that we will explore later. So again, a summary of everything we've done, purchase and rehab. This was the original loan financing, okay, loan number 1. The valuation, as mentioned, 280. We have some numbers per square foot here. We do have the 4-month holding period. We could adjust it. You can see these numbers growing exponentially if you're not able to um, manage the rehab project accordingly. Of course, you still have a profit up to some point, but the faster the better. So let's just keep this at the 4-month assumption. Okay, the refinance, as mentioned, 210,000 loan size. We have some cost, and when we eventually get our cash back after all the cost and the loan is paid off for the payoff of the short-term loan, we have $23,000 coming back to us. We invested 37,500 initially. We spent another 8,400 on the holding cost, and we're eventually getting $23,000 out. So our total cash invested by this calculation is going to be the $14,000. The total cash invested from just a straight cash in at purchase and coming back out on transaction number 2 is 14,000 left in the property. So about 2/3 of a fully paid back BRRRR. It's not 100%, but it's extremely good. So just keep in mind that you're now controlling the property and all the numbers below with $14,000. Okay, this was the refinance scenario. We're locked into a DSCR loan, 30 years, 6.5%. We now have the $1,900 rent showing the operating income coming through. Our expenses on taxes and insurance are $267 a month minus the loan payments. We now have a pre-tax cash flow of $306. Of course, these are taxable amounts in certain situations. You want to definitely take into account rental income is taxable, but it's tax advantaged for the most part. We have all kinds of investment returns here that are showing important metrics. We have the financial ratios, and again, one that I want to highlight here is 1.23 debt coverage ratio. For the DSCR loans, we're always looking for 1.20 to be healthiest. You can go down below that, but here you have 23% more income than expenses, and that's healthy. So when we go back to our purchase criteria that we set up, we are meeting 4 of the 5. I guess we had 5 of these set up. The 5th one here is not working. This is the 70% rule. So if we wanted to go back into that offer calculator, now this is something we analyzed in depth in the first video, so I won't spend more time here, but this is the one. It's being limited by the 70% rule. It's suggesting to offer $5,000 less because of this number. Perhaps we need to be flexible here because this is still a very profitable project and we don't want to have the perfect the enemy of the good, so to speak. So we'll say that every other metric is working pretty well. This is slightly not working, but we're going to go ahead and follow through with the property. Okay, so these are the very important numbers. Look how much information we have in just, it took about 5 minutes to input all the numbers here. Fantastic, but you haven't even seen all of it yet because in the buy and hold projections, we're showing the yearly evolution of the property values and the incomes and all that. So we've set up these appreciation and income and expense growth numbers, 3% per year, very, very conservative. But even with a conservative amount, you can see that the operating income, of course, is growing. Operating expenses do grow, but because this number is bigger, your operating profit is actually going to grow because your income is growing faster than your expenses on an absolute amount. So you can see that the cash flow was just about $300 a month in year 1, but over time, and here we're in year 5 right here, we're now up to 6,000. Year 10, we're up to 9,000. Okay. It's also taking into account the tax benefits for the deductions. You have your operating expenses, you have your interest payment on the financing, you have the depreciation. So look how much on one property you have able to deduct from all your income, including your rental income here. So this is a very serious deduction against not only this rental income, but also potentially other income. And then you can see what kind of equity increases over time. Even after year 1, you've taken $70,000 of equity to 80. And every single year it's 10,000 plus, and then by year 10 you are up to 200,000, and 20 years from now 400,000. Fantastic amount of wealth creation. Remember, $14,000 initial net investment in this property. it's going to be it's going to be swamped by the value here much later in time. So you can imagine if you did this 5 or 10 times, how much property assets you would have accumulating. So DealCheck does provide all these numbers that you want that are important: the cap rate, cash on cash return. Look at this type of cash on cash return, the return on investment, which is aggregating, and then the internal rate of return for every year. So look at year 20, for example, that's making 38% every single year compounding. So incredible wealth building in just a single BRRRR property. Okay, so other financial ratios, you can dig into the numbers here, but this is DealCheck. It's a very powerful software. We've analyzed the BRRRR investment here, setting up the first phase, purchase and rehab, followed by the second phase, refinancing. In just a few minutes, this software has produced a wonderful amount of data for us to analyze the property. From everything it looks like here, this is certainly a project we want to do as often as possible. And DealCheck is something that is going to give you confidence and definitely precision in what you want to do as a serious real estate investor. So recommend to check out DealCheck as a software to make the deal analysis part of your real estate investment activity a lot easier and a lot quicker.